Well, welcome back to another episode of Finance Uncut, where we talk everything finance and economics with an Austrian flavour. In today's episode, I want to share with you a few articles about the US dollar reserve currency being under threat. Let's get to it. All right, so here we have an article from Wall Street, why the hoped-for solution to out-of-control government debts won't work this time. Here we've got the Singapore central bank discussing what central banks have done previously in reducing debts and producing growth. And basically, he's saying that it's not going to work this time. But let's go through the article and let's have a look. So the solution now to the enormously ballooning debts in developed economies: firing up consumer price inflation and letting it run hot, according to the newest dogma trotted out incessantly by the Fed and other central banks, and hope that rapid economic growth will take care of the rest. The US federal government debt alone has ballooned by $3.5 trillion in just 8 months and by $4.2 trillion in 12 months to a breathtaking $26.7 trillion. You can see there from the graph here where that debt is going. Rising inflation and high economic growth worked during the decades after the Second World War in bringing down debt levels in highly indebted countries such as the US, but it won't work this time, said Thurman. I'm not even going to pronounce that last name, so Tharman, if you're watching, I do apologise. But Tharman is the senior minister in the Singapore cabinet, chairman of the Monetary Authority of Singapore, which is Singapore's central bank, and deputy chairman of the Government of Singapore Investment Corporation, their sovereign wealth fund. He was speaking at the opening day of the virtual Singapore summit. I think the big issue in the next decade is how to ensure that debts are sustainable, he said. First, it's obvious that you can't just keep increasing your debts. I don't believe that the new high levels of debt that many countries are now moving towards are going to be sustainable without imposing a significant cost on growth as well as on equity within their societies. The question of equity is how these costs are being distributed over society. In other words, who's going to get slammed by those costs and who benefits? It's not like the post-war period, he said. In fact, after the Second World War, many of the advanced countries started at very high levels of debt. The United States, the UK, many European countries. But they brought it down dramatically over the 30 years. How did they do it? Rapid growth and inflation. And both of those are not possible anymore. Rapid growth is no longer possible. These are now aging societies. Productivity growth is much lower than before, he said. And this is something that Harry Dent has been on quite a lot about the aging population, the baby boomers, and how that is going to change moving forward with the growth of these developed nations. So let's read on. And inflation is not going to be tolerated by older societies, he said. They may be tolerated when societies are young and everyone's incomes are going up, but it's not going to be tolerated now. So that option isn't there. Like medication that is not tolerated and makes the sick patient even sicker. Neither can we assume that today's low interest rates remain low forever. Interest rates will rise to normal levels at some point, and this will raise the cost of this debt, she said. He said. Didn't realise he changed gender there. Anyway, governments must find a way to grow their economies without simply expanding the deficit. It's a very serious issue, he said. Changed his gender again. You're going to need fiscal reforms, not simply cutting down on spending, but you need quality spending and ways of raising revenue that don't dent growth. So there you have it. What everyone already knew has now been said out loud at an official event. The new dogma won't work. There are solutions, as Tharman pointed out, but they're more complex to implement and don't involve the ever so convenient printing press. The borrowing and printing currency forever and hoping for consumer price inflation to reduce the debt burden aren't going to work in creating a healthy economy and prosperity. What consumer price inflation does in today's developed economies is destroy the purchasing power of the currency and thereby the purchasing power of already struggling labour paid in that currency, and thereby dent consumption and create more social frustrations and inequities that would then be addressed with even more borrowing and printing and inflation. So let's jump over to this article from Seeking Alpha. Ugly math, why the Treasury market could implode at any time now. So we're not going to have a look at the whole article. We'll just read this summary part here. Of the $20 trillion in marketable treasuries outstanding, 4.7 trillion is from T-bills due in 6 months or less, so short-term T-bills. Treasury is almost completely reliant on short-term debt to fund the current deficits. The Treasury hasn't been able to raise any net cash from T-bills since June, since 7.3 trillion in this debt has already come due since March. More long-term debt is out of the question. Demand is waning and foreigners are pulling out. We have seen that. We've seen China offloading US treasuries for one reason or another, and that's debated. Substantially more long-term debt would push long-term interest rates too high. Well, that's where the Fed might come in and try yield control. Once again, that's debated as well. Yet another $2 trillion bailout bill is in the works, but there are only $2.82 trillion in total reserves in the entire US banking system. If it passes, the Fed will have to expand its balance sheet by trillions more to avoid another repocalypse. Besides another $2 trillion bailout, a no-deal Brexit could trigger a banking crisis, or a contested US presidential election could destabilise the already shaky Treasury market. So things aren't looking good on this point. And to finish off, I want to touch on two very smart people who I follow, both billionaire fund managers. First is Stanley Druckenmiller, and let's have a look at what Stanley's got to say here. I'll just bring this up.
I think the merging of the Fed and the Treasury, which is effectively what's happening during COVID, sets a precedent that, well, we've never seen since the Fed got their independence. And it's obviously creating a massive raging mania in financial assets. And as you just pointed out, Joe, it has not spilled over to Main Street. I would just say that I hear a lot of people on the air applauding Jay Powell, saying he saved the world. And I do think he did a great job in March. I think the follow-up's been excessive, and I just want all you guys cheering him on to remember the Maestro in 2005 and how that worked out. Look, everybody loves a party. Jeff loves a party. Mommy loves a party. I love a party. I assume you guys love a party. But inevitably, after a big party, there's a hangover. And right now, we're in an absolute raging mania. We've got commentators on your network encouraging companies to do stock splits. Companies then go up 50%, 30, 40%, big market cap companies on stock splits. As Andrew pointed out early in your show today, that creates no value, but the stocks go up. Look, Joe, I have no clue where the market's going to go in the near term. I don't know whether it's going to go up 10%. I don't know whether it's going to go down 10%. But I just want to remind people that there is no valuation support because we dropped 10%. That hasn't mattered because we're so far outside of the valuation realm with the Fed doing what they're doing. That doesn't matter. But I would say that the next 3 to 5 years is going to be very, very challenging.
Yeah, there you go. And he goes on to, let's just move off there. He goes on to talk about the next 3 to 5 years having significant inflation of even 5 to 10%. And if he's using inflation numbers of 5 to 10% based on what's reported, then we know that the real inflation is much higher, because we know that inflation gets reported very differently how it used to get reported in the 70s, 80s, and 90s. And so the real true inflation's always higher than what's reported. So that's not good, but let's have a look at this. Let's finish off with this. And this is Ray Dalio. And this is the big one. He warns of threat to dollar as reserve currency. And let's have a quick look. This is only a short article coming in from Bloomberg here, or investing.com. The dollar's decades-long position as the global reserve currency is in jeopardy because of steps the US has taken to support its economy during the COVID-19 pandemic, according to Ray Dalio, founder of hedge fund giant Bridgewater Associates. For those who don't know, it is the largest hedge fund in the world. While equities and gold benefited from the trillions of dollars in fiscal spending and monetary injections, those efforts are debasing the currency and have raised the possibility that the US will go too far in testing the limits of government stimulus, Dalio said Tuesday in an interview with Bloomberg Television. There is so much debt production and debt monetization, Dalio said. And once again, that is debated in the FinTwit world. But, Dalio runs the largest hedge fund, so, who am I to question him? The Bloomberg Dollar Spot Index has dropped 10% from its peak in late March as investors responded to the pandemic and efforts by central bank and government officials to contain the economic fallout. All of the world's major developed currencies have gained against the dollar, as have precious metals such as gold, silver, and platinum. Don't I know? Dalio said in July that investors should favour stocks and gold over bonds and cash because the latter offer a negative rate of return and central banks will print more currency. And that's why I'm bullish on precious metals. Bridgewater has been moving into gold and inflation-linked bonds in its all-weather portfolio, diversifying the countries it invests in and finding more stocks with stable cash flow. Many others, like the great Jim Rogers, is doing the same. He's investing quite large in Russia and outside of the US. Warren Buffett has dumped his bank stocks, his airline stocks, and he's recently purchased a bunch of Japanese stocks as well as Barrick Gold. And that's quite interesting coming from Warren Buffett, who's always said that gold is a useless investment, and he's always said never bet against the US. Well, his actions are certainly painting a different picture there. Also, Peter Schiff from Euro Pacific Capital is also investing a lot outside the US into other investments. So Bridgewater's flagship Pure Alpha 2 hedge fund has had a tough year, tumbling 18% through August amid the market turmoil fueled by the pandemic. The firm took a hit at the worst possible moment because its portfolios were positioned at the start of the year to benefit from rising markets, Dalio told clients in mid-March. The Westport connective-based firm manages about $148 billion, down from roughly $160 billion at the start of the year. So there you go. Ray Dalio is warning that the threat to the US dollar as the reserve currency is here, and he's not alone. He's not alone. This is something in the FinTwit world which is highly discussed significantly. So what do you think? Do you think that the policies that central banks and governments around the world are doing is going to help or hinder? I certainly think it's going to hinder, and I also think that this fiat currency US dollar reserve system that we've been in is certainly coming close to its end time. How long it can go on for, I don't know. But we certainly are in the latter stages of our current monetary system. So thanks for joining me. I'll see you again on our next episode. See ya.